Welcome to the July 2015 episode of RiskStudio. In this episode, I will discuss the topic of risk appetite with Rob Jeges, who is participating from Australia. Rob has over 30 years of professional experience. He's an independent consultant specializing in project management, risk management, and organizational design. Rob has developed, implemented, and operated several program management offices responsible for the monitoring and coordination of entire portfolio of technology projects and development of project management capabilities. In the last episode, we discussed the topic of risk appetite with Alex Sidorenko. In this episode, we extend the discussion to cover how the principles of risk appetite can be implemented within ISO 31000. Welcome, Rob, to this episode. Let me now hand over the virtual stage to you so you can kick off the discussion on this very important risk management topic.
Thanks, Manoj. It's a pleasure to participate in this. Today, I'm going to talk about risk appetite and how is that handled by ISO 31000. In order to understand this, we need to look at a few things. What do we mean by risk appetite? Why is this important or not? And how can we implement that within the ISO 31000 standard? Perhaps a good place to start is asking the question, how much risk is sufficient? Too much, too little? We know that risk and uncertainty are connected, and any enterprise that we try is going to be affected by risk. We also know that the first principle of risk management is to create and protect value. So we can form an idea using these concepts that risk is going to have a shape like this parabola of some sort, and there is an optimum point where the maximum value is created or preserved. If there is negative consequences, if the risk introduces negative consequences, we're going to lose some value. And if we don't have enough positive consequences, we are not going to be able to create enough value.
So, Rob, on this particular graph, when you're referring to risk, are you referring to a specific risk, or is this the collection of all the risk an organization would be exposed to?
Well, this can be one risk, or the aggregation of all the risks. It can be of any type or kind. It's just a conceptual view that all the risk that is going to affect a particular objective or collection of objectives is going to be affected by uncertainty, and some of the elements of that uncertainty are going to create value, and some others are going to destroy value. Risk appetite is a concept that is discussed, is talked a lot, but there is no real consensus of what it means. There are many ideas and definitions that go around, but it is usually a problem. It's a problematic concept. The way it's usually presented is not very useful. You cannot really operate with it. So a lot of people, including myself, tend to see it as a bit of a difficult thing to work with. But if you take some time and you build a model around it, you discover that it is not only workable, but one of the fundamental principles of risk management. So we're going to start looking at some of the elements of risk appetite. Using the source of this is a document that was produced by Ernst & Young back in 2010 called the Risk Appetite Strategic Balancing Act, and is one of the best collection of definitions that I've come across. So it talks about risk capacity, which is the amount of type of risk that the organization is able to support. So that gives us a concrete limit, and it's about the objectives, of course. Tolerance, on the other hand, is how much the organization is willing to take. So there's a difference. One, sets a firm constraint, and the other one is a matter of decisions, management decisions. At a third level, we can set up a risk target, which is the optimal level. And if we recall on the previous slide, there's a point where we're going to maximize the value, and that is the optimal risk that we should be aiming for. That is a target. And in order to help manage all this, we can set up risk limits that gives us a threshold so we can monitor and measure when we're getting too much risk or too little risk. So if we put these ideas together, we can then get a better understanding for what risk appetite means. Going back to the previous graph, we have superimposed the risk capacity that gives us a broad range of risk, and then that is what the organization is able to bear. If we move the risk beyond capacity towards the right, we get into a point where the organization is not able to withstand that risk. And if, on the other hand, the risk that the organization is going to take is too little, then we're not going to be chasing opportunities, we're not going to be able to create value. So that is also a no-go zone. What is interesting of this is that risk capacity is not just a number, it is a band. It is a range of values that defines risk. The same for risk tolerance, and that is, if we recall the definition, is how much the organization is willing to risk. So again, we have a band, and somewhere in the middle, we're going to have a target which should correspond to the optimal value, where value is maximized. If you're familiar with COSO, you probably identify this graph in some way, because the idea of optimal risk is also presented by COSO. Another concept that we recall from the previous slide is risk limits. And those are 2 points that we're going to define when the risk is becoming too much or too little. So that is for managing within the risk tolerance, and the purpose is to aim towards the target. Now, what's interesting of this model is that risk appetite does not appear as a set quantity or line or thing like that. What risk appetite is a collection of all these, and it represents, as the definition tells us, the amount of type of risk that the organization is willing to accept. So here we have all the elements that are coming into play. We have a capacity that sets a hard limit. Then we have the tolerance, which is about the willingness of the organization, and a risk target that sets us a course, a direction, what to aim for.
So, Rob, one of the assumptions we're making then in this graph is that it is possible to actually quantify the different definitions you are highlighting here, like the risk target and the risk tolerance, which then, of course, in real life, it may not be possible to financially quantify. So what is the practice you have seen organizations adopting in those type of scenario where it may not be fully possible to quantify these different parameters we are covering here?
Yes, that is a common problem. We need to understand what we mean by quantifying and also by measuring. A quantification, a numeric quantification may not be possible, but we can always set up some sort of measurement. Like, for instance, on an ordinal scale or a set of values, 1, 2, 3, or ABC, or anything like that. So these concepts can always be set up as a measurement, not necessarily measured as numbers in a quantified way, but there's always a way in which this can be defined. Of course, the model works a lot better when you have numbers, because you have the power of calculation and things like that. But if that is not possible, and in many cases it is not, you can always develop the model using some other kind of measure.
So Rob, within financial services, according to Basel, you need to set aside capital, for different types of risks like credit risk, market risk, operational risk. to comply with the Basel regulation. So do you think that capital which is allocated by the banks, it would be equal to which of these concepts we are covering here? Because from my understanding, it'll probably be equal to the risk capacity concept we are covering here, the capital which banks are setting aside for the different risk categories. Is that a correct understanding?
Absolutely correct. And that is one of the problems that we see with Basel, that the regulator is concerned with the right side of the curve. They want to make sure that the risk is not exceeded. And the financial organizations, most of the time, are concerned with the left side of the curve, where they can take more risk in order to increase the value. So there is, two forces that come to play, and the idea is to find that target, that right balance. But that is not very, very easy, because there are a number of other problems, like, for instance, the issue of systematic risk. We're going to see a bit later, but one of the problems that you need to look at is that the risk capacity is usually a combined measure. And when you look at risks on one by one, individually they may well be within capacity, but if you aggregate, you may exceed that capacity.
Sure. Thank you, Rob. And also from the perspective of what is defined at the individual risk or risk category level, and what may be defined, let's say, at the business unit or the organization level. So my understanding is that maybe risk capacity may be defined at the business unit or organization level, but things like the risk target or risk limits, and maybe even the risk tolerance, may have to be defined at the individual risk category level, so maybe just at the fraud level, and in some cases maybe down to the individual risk level, assuming that those are the important risk. Is that the practice you have seen in terms of at what level all these different parameters are defined within organizations?
Yes, that applies. But risk capacity is also assigned at the operational level with concepts like value added or value of capital. So you can put a value in capital, and that sets a capacity limit on what the business unit or the actual project can do. So we have seen a number of elements that define risk appetite. We have capacity, we have tolerance, we have a target, we have limits. But another important element that we need to bring into the equation is the idea of risk attitude. Risk attitude talks about the organization approach to pursue, retain, or turn away from risk. And that is a relative term. It depends on the values that are being pursued and how the utility of that values is regarded by the organization. The idea of utility is how important is the value to me. So a dollar is a fixed unit. It's objective, but it has different utility, different people. If it's my last dollar, then it is very important to me. If I'm a millionaire, then it doesn't really matter. So that is an important concept to bear in mind. The reason for that is that when we set up the various parameters of risk appetite, like tolerance and the target, we are blind. We don't really know where the risk lies. That red curve that we saw before is not really known. So we need to make decisions about how wide the risk tolerance is going to be and where is it going to be positioned within risk capacity, towards the left, in the middle, towards the right.
Okay, so on this slide, just to help our audience understand that graph you have, Rob, is it possible to just share one or two examples of maybe a positive attitude and a negative attitude?
So if we come back to the Basel discussion, a positive attitude is the willingness of banks to lend more and to lower the amount of reserves required to do business, because they're pursuing business and opportunity. On the other hand, the regulator would have a negative attitude towards risk, and they raise the amount of capital that needs to be provisioned to make sure that there is no default.
Okay, and so positive attitude, can all. I think I've also seen term like risk seeking. That if you are a risk seeking person, then that's where you're probably on the positive attitude side of that graph, and if you are risk averse, then you may be on the negative attitude side of the graph. So is that a correct sort of understanding?
Absolutely correct.
Okay.
When you are trying to create value, you will have a positive attitude towards risk. You're going to venture more in order to create that value. When you have that value, you're trying to protect it. So you have a negative attitude towards risk. You try to conserve and keep. So you're risk averse.
Right. And on risk attitude, Rob, so I think the common sort of discussion I have heard is that it varies because the risk attitude, so even on a board, for example, uh, each director on the board individually, may have a different risk attitude, but then there may be as a group, their risk attitude may be different, which may be then different to the risk attitude of an organization. So in context of risk appetite, which risk attitude, are we looking at? Are we looking at the individuals? Are we looking at the collection of individuals as groups? Or are we looking at the organization risk attitude? Because, it may vary depending on at what level you're looking at the risk attitude.
Yes, risk is always referenced with an organization, and that can be an enterprise, a group of individuals, or a single person. So risk attitude must always refer to that organization. And in the case of a board, for instance, the risk attitude needs to be an agreed statement, a position that makes everybody in that group comfortable.
So generally, I haven't seen a risk attitude discussed in the context of risk appetite. So what was your intention here to bring risk attitude? Because I think it's an important discussion, which normally I don't hear in the risk appetite context. So was there a specific point you were trying to communicate here, which we want to highlight?
Why is risk attitude important? If we come back to this model, what is important to bear in mind is that that red curve is unknown. We don't know how risk is moving, so we're going blind. And in that, without that knowledge, we need to define the band for the risk tolerance. How wide is that going to be? The risk attitude is going to help us define and position that risk tolerance band. So far, we've been able to build a model of risk appetite where there are a number of parameters that come to play and collectively are known as risk appetite. Why is risk appetite important then? Because it is a foundation of risk management. It helps us to define what parameters of risk are we going to manage and what is our target and how we're going to manage within those limits. If we set up these parameters, this promotes transparency and helps prudential controls, particularly with risk capacity. And we can see, if we recall that that parabola of risk, it allows to create value and to protect value. The game really is to find that optimum point where risk is, just enough. A bit more, we're going to lose some value. A bit less, we're going to miss some opportunities.
Yeah. And something which we also discussed with Alex Sidorenko in the previous podcast, Rob, was also the fact that we want risk appetite to be relevant or a key input when you're making key strategic decisions or the key business decisions within an organization. So I'm guessing that all the bullet points you have here, they're probably driving to that one area, that if risk appetite does not help business decision makers in terms of what risks they should take and not take, then the risk team may not have done a good job in terms of risk appetite. So would you agree that sort of is one of the key drivers of a useful risk appetite implementation, is that it should be helping the decision makers when they're making the decisions in terms of which risks can be taken and which risks cannot be taken?
Absolutely. Without these ideas of risk appetite, we would be flying blind. We don't have a target, we don't have a direction, we don't have a capacity, so the decisions will be made on the void. Risk appetite is essential to manage risk and to make decisions. So when we set up the risk appetite parameters, which is capacity, tolerance, target, and limits, one of the questions that we need to ask ourselves is that which level are we going to define this? We have a number of options. We can set it up at a strategic objectives level. It could be the aggregation of all the risks in the organization. It can also be for a single objective, a project or a component of a project. All those levels are valid, but we need to decide how are we going to use this risk appetite, what is the purpose, and we need to choose the particular level. Another consideration is how are we going to value this? We need to choose common units if we want to aggregate. For instance, we need to give value, dollar value to money if we're going to use money as the common unit. If we are dealing with assets in the workplace, we need to consider the human life, and if we're going to mix that and give a value or not, and that kind of things. Another question that we need to give some thought is whether we're going to focus on the resources or the consequences of events. Sometimes risk appetite is going to focus on what kind of risks we want to pursue or avoid. Some other times we may want to focus on the consequences of events. And coming back to the question of quantification and measure, we also need to think about the question, how are we going to measure this? Measuring quantified risk is easier, if you like, but you can also measure using other scales and other ways. So measure and quantification are not synonyms. And also the other important thing is what's the reference of that measure. We assigning value with reference to what.
So Rob, are you able to explain to us that last bullet point? What do you mean by what is the reference in the measurement context?
Sure. The process of measuring is really a process of comparing. When we measure the length of a piece of wood, we are comparing that length with a gauge, which is a measuring tape. When we're measuring the value of goods, we're comparing to a reference, which in many cases it could be the utility, how valuable they are to us. When we measure cost or benefit, we use money as a reference. So there's always measuring involves a comparison with something, and that reference is important to define. So one of the common things to do with risk appetite is to create a risk appetite statement. This is in many cases a requirement of a regulator, but it it's generally a very good idea because it consolidates the ideas about all these concepts. Risk appetite, as we discussed at some point, it can apply at a strategic level, at a high level if you like, and also at an operational level. So when creating a risk appetite statement at a high level, the main thing is to clearly identify the major risk areas, and it could be in part quantitative and qualitative, but mostly it is going to be qualitative. And there are a number of examples of risk appetite statements where typically people talk about having a high appetite or a low appetite, that kind of language. The second way in which risk appetite can be written down is for the operational risk appetite statements. And these need to be detailed documents that, where the various parameters like capacity and tolerance and so on are properly defined and articulated. This is where quantification becomes important. So here we have a couple of examples. The risk appetite statement from the Reserve Bank of Australia talks at a high level. And what's interesting here, if I can just quickly read, in terms of operational issues, the bank has a low appetite for risk, so that is a qualification. And the bank makes resources available to control operational risks to acceptable levels. What is an acceptable level? We understand, but there's no measure there. What is interesting is the final sentence that says that the bank recognizes it is not possible or necessarily desirable to eliminate some of the risk inherent in its activities. Acceptance of some risk is often necessary to foster innovation within business practices. So they have a low appetite for risk, but there are some risks that they're willing to accept. Here is another example, which is an operational risk appetite statement. This one is from the University of Edinburgh, and where we can see a number of actual measurements. So we have achieved a surplus of a minimum of 2% of gross income over any 3-year period, operate with a staff cost to total expense ratio of not less than 60%, and so on. So here we're introducing operational measures. These can be used as parameters within a risk appetite framework. We can set up tolerance using these. Okay, so far we've been able to create a risk appetite model, and we have a number of important concepts that set up some parameters to manage. Risk appetite is fundamental to risk management because it sets up the parameters to manage. Without risk appetite, we would be flying blind. We have no goals to pursue. So the question is, how can we implement this using the standard? We know that there's no definition of risk appetite or mention, but it essentially, being a fundamental concept, it can be implemented. There are two building blocks for risk appetite. The first one is the risk criteria. It is the terms of reference against which the significance of a risk is evaluated. So the risk criteria, tells us what is going to be a risk and how big or small that risk is going to be. So this fits nicely with the ideas of risk capacity, risk tolerance, and risk limits, because it's going to define the criteria for risk. We know that capacity is going to give us hard boundaries that we cannot cross without harsh consequences. Risk tolerance, that gives us something to work within, and risk limits that help us manage that. So risk criteria is really the container for these concepts. It's important to remember from the standard that risk criteria needs to be set up early in the process. It's one of the first things that we do when we go through the risk management process within the establishing of the context, because again, this gives us the direction. It works like the compass for risk management.
Yeah, and something I would like to highlight or share here, Rob, also is that element of the terms of reference against which the significance of risk is evaluated. Because what I have seen is that organizations do the risk analysis. So let's say they analyze all the residual risk, inherent risk exposure, and then they scratch their head saying, okay, what do we do now with all this risk analysis we have done? And that's where, if the risk criteria is not defined much earlier into the process, then you may not end up doing anything after you've done the risk analysis, because you have nothing to compare the outcome of your risk analysis against. And I don't know how many times I have seen organizations sort of make that mistake where they don't focus so much on the risk criteria. They just do the risk assessments, and then there is no way to know which of the 200 risks require closer attention, and which one can be ignored.
Absolutely. The risk criteria is like a map. Without a map, you could be anywhere, and the landscape is going to look interesting. There will be features to look and so on, but without the map, you don't know what it means. The risk criteria gives you that context. When you are analyzing risk, you don't know what that is going to mean unless you have risk criteria to compare with. So that is the reference for measurement.
Yeah, and something it'll be interesting to get your take on this, Rob, is so even though risk appetite definition is there in ISO 31000, but it's the term is not used within the main document, but still the principles or the concepts around risk appetite are still implemented or still part of the ISO 31000 through risk criteria, is my understanding. So is that your understanding also, that even though we're not using the term risk appetite, but still the benefits and the way in which you want organizations to think about risk is covered by the concept of risk criteria within the main ISO 31000 document?
Absolutely. Risk appetite is not a single number or parameter. To me, risk appetite is a collection of ideas. It's this capacity, the tolerance, the limits, the targets, and everything. Mm-hmm. So what we're doing now is looking at the ISO 31000 places where these elements are identified, and we find them quite easily. So under risk criteria, we find risk capacity, risk tolerance, and risk limits. That's where they belong. So 3 elements of risk appetite are already there. They're part of the risk criteria. So without mentioning it by name, mm-hmm. we have a lot of elements of risk appetite already in the standard.
Right, yeah, because this is where I have heard people make statements saying, oh, ISO 31000 does not provide any guidance on risk appetite. And yeah, I think that is not 100% correct, because yeah, the word risk appetite, the term risk appetite may not be used, but if you really look at the principles of that, then they're definitely very core part of the ISO 31000 guidance. It's just called risk criteria instead of risk appetite.
Absolutely. So here we have a few practical guidelines on how to define the risk criteria. The first thing to notice is that it is not a single item. It's not a criterion. Risk criteria can be a number of elements that are relevant to risk. Like, for instance, what is the capacity, what is the tolerance, and so on. And risk is usually composed of a number of events that play together. So for each of those events, you may want to define separate risk criteria. So there is a lot of work. Risk criteria is not just a single statement. There are a number of elements to consider. The second very important thing is that risk criteria is going to be used as a reference when we move on to level of risk. So we need to use the same units because we are going to compare. So we have to have that in mind when we define risk criteria. The third thing to consider is that usually we are dealing with uncertainty, so we should specify a range. There's going to be some variance, and we need to bring that into the thinking process. The only exception to that is when we're defining a limit or a threshold. In that case, a single number could be a valid thing, but most of the time we need to specify a range of possibilities. It is important to define the risk criteria before doing the risk assessment, before going into the identification and analysis of risk, because again, we need to set up the map before we go in the journey. The risk criteria must relate to objectives. Again, there is consideration of risk sources, and people can be diverted by that, but you have to always have your objectives in mind. The level of aggregation must serve a purpose. So if we go back to the question of the enterprise risk appetite and the specific risk appetite for projects or single risk and so on, we need to think and design that level of aggregation early in the process. And finally, it needs to be easy to communicate. We're going to do a lot of work with stakeholders, and we need to be able to articulate and communicate this very easily. And it needs to be owned by the organization. Actually, the owner is going to be the risk owner.
Okay, so let me pose one question to you here, Rob, which I normally get during my training courses. So generally, before ISO 31000, when we talked about risk criteria, so let's say at least in the financial services, they may define, for example, financial, reputational, customer. So there may be 4 or 5 criteria defined like that, and then organizations would then go and define saying, okay, what would be a high, medium, low for financial, what would be high, medium, low for regulatory, fine, and so on, which was very easy. But then when you especially look at the point where risk criteria must relate to objectives, you start the risk criteria can start getting very complicated, because if you're looking at, let's say, an IT operations where the objective may be that, yeah, we don't want to have any unplanned IT system downtime, then your risk criteria will relate to the system downtime. Then the financial aspect of the criteria may not be that relevant, because the objective is to keep the systems up and running. So your risk criteria is about that. Then if you go to health and safety, that's where the criteria may be to minimize, let's say, the injuries to employees due to accidents and so on. And then the risk criteria will relate to the number of accidents. But then if you go to the financial side of, let's say, the trading side of a bank, then that's where the risk criteria will be more about the financial numbers. So the question I get is that it can get very complicated to define risk criteria, that you may then end up with 15, 16 different topics within your risk criteria. And then depending on which risk you are assessing in which part of the organization, only 4 or 5 of those 16 topics may be relevant for that risk criteria. So is that something you've also seen, that defining risk criteria when you're looking at across the bank can get very complicated? And what is some of the guidance to how we can simplify that?
That is a common problem. That's why the 2 things that are important to bear in mind is, one, it must relate to the objectives. So there are many objectives, and each of the objectives is going to have a different set of risk criteria. It is a trap to try to generalize because you end up with things that don't really match well together. So for each separate objective, you need to think what is the relevant criteria. For IT, it would be the outage time. For health and safety, it would be lost time to injury, and so on. Of course, financials are important. But trying to use a common denominator is going to lose you detail and focus, so it's not a good idea. The other consideration is the level of aggregation, so you need to bear that in mind. If you need to come up with a consolidated risk criteria for the whole enterprise, you will have to find some common denominator, usually money, and then you need to have some way of assigning value to each of those objectives. But that's where it gets tricky, because what is the value of reputational loss? How would you compare that to the value of a loss of life or things of that kind? So not always is possible to aggregate to that level. You may end up having a number of categories, but that's fine. And that's a better approach than trying to have a universal single number.
Right, yeah, because what I have seen is that, let's say you have three topics in your risk criteria. So you may have financial, your employee safety, and there may be operations or disruption to operations. And then when we go and talk to IT, they can only assess or analyze their risk in context of the operational downtime. They may say, hey, I don't know how to quantify and put the financial aspect of the system downtime, that it is very difficult to measure. But yeah, they can easily do the assessment in terms of how much system downtime may happen. Similarly, the health and safety people may find it very easy to quantify the health and safety related criteria, but they may not be able to quantify, the disruption to operations. They may not be able to quantify financial. But a lot of organizations, they have a fixed list of criteria, and they want every risk to be assessed in context of those criteria. And that's where, depending on what risk you're looking at, some of the elements of the risk criteria may seem irrelevant, but then because the framework says, no, you have to assess all three criteria, you just capture then meaningless information, or not so useful information in that process.
That is a problem, and I've seen that a lot too. But what usually happens is that people switch off and just tick boxes. The problem is like, how do you measure a car? You can look at different cars, but you cannot really measure them as a whole. You can measure and compare the power of the engine, or how many passengers, or the comfort, or things like that. But each of those is a different dimension, and when you're making a decision which car to buy, you need to look at these things separately. You cannot arrive at a single measure. Well, eventually you can use some sort of, weight averages or things like that, but you cannot add and mix and match these things. So in risk, you should stay away from that as well. You need to look at the criteria which is most relevant for a particular risk, and work with that. What you're trying to do is minimize the uncertainty. So it's got to be different in different cases. So we have an example of risk criteria, and this comes from a construction project where we have an objective which is completing the foundations within a certain time and cost, and to meet specifications. So if we come back to the risk appetite parameters, we can see a risk capacity where we may have a budgetary constraint that we must not exceed by 5%. The scheduled dates may not vary by more than a week, and that's because there is other work that needs to proceed or needs to follow. So too early is not good, and too late is not good either. And we may have engineering tolerances for the actual concrete, defined by the Australian standards 3600 for this kind of work. As risk tolerance, we can have the cost tolerance, it's with upper and lower limits on selected items. So a particular item can go more than 5%, up to 10%, but only a few items. So we are within capacity. And we may have a schedule tolerance of plus minus 1 day. So for the whole, the capacity is a week, but as a tolerance, we wouldn't like more than 1 day variance. And in this case, we could specify risk limits in the same way as the tolerances. So if we exceed 1 day on schedule, then the alarm should start ringing and management action or intervention is required. We are within capacity, but we have already set up things in motion. So we can see the elements of risk appetite, sitting quite nicely within risk criteria. So the second building block of risk appetite within ISO 31000 is the level of risk. And this is defined as the magnitude of the risk or combination of risk expressed in terms of the combination of consequences and their likelihood. This is one that causes a lot of pain to a lot of people because it can be interpreted as multiplying probability by consequence and getting a single number, but that is not necessarily the way to go. The word combination means combination, not multiplication. And what the level of risk does is to bring the final element of risk appetite into the equation, which is a risk target. So the level of risk is going to help us compare the assessment of the risk with the target, and it's going to help us make a decision whether we are where we want to be or not. The level of risk is determined during risk analysis in the risk management process, and it must be done after you have defined the criteria, because it is when you define risk criteria that you're going to specify how the level of risk is going to be determined.
Yeah, and I think it's very important. I'll emphasize that again, Rob. I know you did that. That is definitely not multiplication of likelihood and consequence. That it has to be some intelligent combination, and again, that combination or how you combine the likelihood and consequences, may vary, based on different types of risks. So whether you're looking at the IT system disruption type risk, or you're looking at health and safety type risk. That it's very important to think about that combination of how the likelihood and consequence, derive into the level of risk. Because I've seen that organizations do a simple multiplication and then they start aggregating, and then you quickly lose the real information, in all those maths formulas in your
Absolutely.
analysis.
It is very important to read this carefully. It talks about combining consequence and likelihood, which is not multiplication. There are various ways in which you can think this. Now, when and how are you going to decide that combination? That is when you're setting up the risk criteria. The other thing to remember is that there should be as many level of risk determinations as risk criteria are defined. So this is not a single number, it's a collection of parameters that will describe risk. So it may well be that the product of what we call the expected value of risk is one of the level of risk, one of the criteria, but the variance and various other elements can also be a part of it. So there are a few hints here on the things that you should or shouldn't do when you're determining level of risk. One important thing to remember is that you're not measuring level of risk because you're dealing with uncertainty. You're determining it from the information that is available. It should be done during risk analysis, and that is after you have identified the risk and after you have set up the criteria. And it must be commensurable with the risk criteria because you're going to be comparing. And it must be done in the same units, whether they're quantitative or qualitative. Each risk criterion should have its own level of risk, so there may be several. And as we said before, it could include things, for instance, like the expected value, the variance, the shape of the curve, whether it's spread or concentrated, whether it's symmetric or not. Well, all these considerations could be elements to properly determine levels of risk. Another thing that people tend to forget is that the tail events should also be thought about. These are the very unlikely remote events, but you need to give thought to those as well. The last point is the aggregation of various risks in risk profiles. If we recall from ISO 31000, a risk profile is a collection of risks. And the rationale for collecting, for making a group, can vary, but it is very useful when you're aggregating levels of risk, and when you have a collection of similar or related risks, you can aggregate within. So you can give special thought to the units and measurement and things like that. Typically, you're going to have a risk profile for financial risks, another one for HR risks, another one for reputation, emerging strategic, things of that kind. Finishing these thoughts on risk appetite, we know that uncertainty is the foundation of risk. Risk is defined as the effect of uncertainty on objectives. And risk appetite is, by the same token, the foundation of risk management. Without risk appetite, without these ideas of tolerances and limits and so on, there is no point in doing risk management. To manage something, you need to be able to measure it in some way, and risk appetite defines those measurements. One criticism that is made of risk appetite is that it only applies to the finance sector. But I think it is a universal concept. When you think of it in terms of these parameters that are built within the risk criteria and level of risk, it applies to any risk, to any sector, any organization, anything dealing with risk is going to be affected by the same parameters. Risk appetite is not a metric. I think it is a collection of several elements, several parameters that you define and manage. So if you try to define what is your risk appetite as a number or as a position, high, medium, low, you're really missing the richness of the concept. And that richness comes into the ISO 31000 terms and definitions. And we have seen that it is sufficient and adequate to work with the risk criteria that is going to incorporate risk capacity, risk tolerance, and risk limits. And the last element, the risk target, can be expressed by the level of risk. So we have all the elements of risk appetite within ISO 31000. It is true that it's not mentioned by name, but it's definitely there, and it's one of the core elements. Without these elements, there is no risk management.
Great, and thank you, Rob, for emphasizing the third point again. I think that also came up in the previous episode with Alex, where in some countries, some regulators, they are forcing organizations to come up with one risk appetite number, and I think that's probably practically impossible. And even if you are able to come up with that number, I don't know what that number would even mean. So thank you for you sort of emphasizing that risk appetite is not necessarily about coming up with a single number. Uh, so to close this session, then Rob, I think I will just like to highlight some of the key takeaways from my side, and then I'll give you the final floor, and then we can close the session. So I think the key takeaways for me from this session was, I think you mentioned to look at risk appetite similar to a map. I think that's a good metaphor or analogy we can use when we're thinking about risk appetite. That if you don't have the map, so if you don't establish, let's say, your risk appetite or risk criteria early in the process before you do your risk assessment, then after you've done your risk assessment, you will probably be clueless in terms of what to do with all that analysis you have done. So I think that's a good analogy for practitioners to sort of consider and use. I think your coverage of risk attitude, I think, was also different. I haven't seen risk attitude being covered separately in context in the risk appetite discussion. But I think from what you covered, I see that as a very important source, that without knowing what the risk attitude of an organization is, it may be very difficult to set up the different the different parameters we looked at, like risk limits and risk tolerances and so on. So I think that for me was very useful to include in the discussion. You also shared some examples of the risk appetite statements from two real organizations, because that's a common complaint or a common concern I get when I present in training or conferences, that there are not so many public examples available of risk appetite statements. So it's always good to see some organizations have published that. Actually, I would like to understand what is your take, Rob, in terms of publishing risk appetite statement for the general public. That I see that there could be a lot of confidential information into risk appetite statements. So I can see why organizations would be reluctant to publish the risk appetite statement publicly. But beyond the regulators and the public sector type organizations, which may have to publish this information, have you seen the private sector or risk appetite statements being published by private sector organizations?
Not publicly. What happens a lot is that when risk criteria is done properly, all those elements are well documented, but again, they're sensitive, so they're not usually shared. But I've seen and developed them for internal consumption. The high-level statements are more available because they set up direction and they read well. There are a number of, not that many, but there are a number of good examples around. You can read and form that view. It gets tricky when it gets to brass tacks because people are not willing to share that information. If I could close, I'm no fan of risk appetite as the term is used, generally, because it doesn't have any power. It's not operational, and it's really something, like a statement, a high-level statement. What I'm very keen on is risk appetite in the operational way, where you define criteria and you work with these parameters. That's where it's very useful. So you don't have to mention it by name, but certainly apply the concepts.
Absolutely, yeah, and I think I go back always to that point that if when I'm making a big business decision, and if the risk appetite statement or the risk appetite principles which are defined by the organization, they don't help me to make that decision, then probably it's not been defined in the right way. But if the risk appetite statements or the risk appetite parameters like tolerances and risk capacity and so on, if they help me in making my business decision, then as an organization, we've probably done a good job on defining our risk appetite or risk criteria. So I always sort of take that as the litmus test, to see whether we've done a good job on risk appetite or not.
Yeah, that's very true.
Absolutely. Okay. So, Rob, thank you very much then for sharing the concepts and lots of practical examples with our audience today. And we hope to talk to you again in the near future on maybe another risk management topic.
Thank you, Manoj. It's been a pleasure.